Swoboda Research Centre. I'm going to ask Paul Cope from Northern Mutual Credit Union to welcome you this morning.
Right, good morning everyone, and a very warm welcome to Liverpool in a fantastic setting in our city. It's historic, right throughout the world, and it's brilliant to have everybody here. It's actually the first time I've visited the Liverpool building as well, so it's the first for me as well. I'm Paul Pope, I'm the CEO of Northern Mutual Credit Union, and I'm absolutely delighted to be opening today's Swoboda conference here in our city. Whether you travel far, make the journey across the Irish Sea, or you're from just around the corner, it's a real pleasure to have you all with us. Liverpool is a city built on community, resilience and solidarity, values that sit at the heart of the credit union movement. It is also known for being home of two famous football teams, Liverpool and Liverpool Reserves. We're also proud to be home of 10 credit unions across the Merseyside region, each one deeply rooted in their communities, and all working collaboratively through our recently formed Merseyside Credit Union Alliance. This alliance isn't just a name, it's a key example of what can happen when credit unions come together with a shared purpose to serve, to support and to empower. The spirit of innovation and collaboration is exactly why I keep coming back to Swoboda events. This is my fourth conference after attending the first in Dublin last year. They're more than just conferences, but a chance to reconnect and to challenge ourselves and be inspired by the incredible work happening across our sector. Every time I attend, I leave with new ideas, a renewed energy, and a deeper sense of connection to this movement that we all care so deeply about. So thank you all for being here. Thank you for the work you do, day in and day out, to make financial services fairer, kinder and more inclusive. I hope today brings you fresh insights, meaningful conversations, and maybe even a few new friendships along the way. Thank you.
That's fantastic. Thank you very much, Paul. We have a fan here who's travelled from Wisconsin. So, George, I do apologise for so, just want to wrap through the day, say a few thank yous before we get going, and also just put thought out there to get everyone's mental juices going before we get into the discussions themselves. But just some housekeeping, there is no 5-year-old plan, so if the fire alarm goes, it's serious. Head that way, and the staff will look after you. The Wi-Fi was hooked to the Wi-Fi on the TV screen for you, it didn't work out, but if you need the Wi-Fi, register events guest, welcome to the venue. And you will need the Wi-Fi because later on, particularly in the session that Molly Harris is leading, you'll be doing some stuff online voting. So please be ready for that. And all the materials you get to see today will be available afterwards. And there should be coffee time pretty much all the time. Do feel free to go out there and grab a soft drink. Just want to say thank you to our corporate members whose support for Swoboda enables us to subsidise these kind of events. And also, some of them are exhibiting out the back there, so do take a moment to say hello to them and to Dina and Quantuma, who are exhibiting this year. I wanted to, because I don't know, I'm not sure we've done this before, just introduce you to the faces of Swoboda. Kind of the left-hand side there, that's our board, which is great. Credit union leaders from Britain and Ireland, many of who you will know, with myself and Paul Jones as well on that board. And me and Paul are part of the team that does a lot of the legwork. Brigine, who's just recently joined us from Dundalk. Where are you, Brigine? There's Brigine. Brigine has done so much work to sort this conference out. So thank you very much, Brigine. Gary is your man if you want to talk about partnering with Swoboda in any way. We can talk about joining Swoboda. Gary is your man. And Sheila is keeping us on track with the United Vision project that Paul's going to talk about later. So that is the Swoboda team. I just wanted to make you aware of. There's lots of people involved in helping you enjoy these kind of events. Just a quick update on us. We have got a lot of research underway. Unfortunately, some of it's kind of got stuck in the pipe. So I was hoping to have had about 3 or 4 more papers with you, reports with you this year. But we have most recently a really interesting paper by Lucy Haar from the States, just talking about credit unions and banks. Are we banks? Are we not banks? Some of you out there are branded bank. What does that mean? So a really interesting paper, that one. We've got loads of stuff coming, but one of them is about looking at the common bond. And Chris Smythe, who's writing that for us, is here today. Anyone got any questions, grab Chris. And also something on director remuneration, which Paul and I are working on as we speak, just looking at the whys and wherefores of remunerating directors in the credit union movement. And the I4 incubator, which I'm going to talk to you about this afternoon. That's really exciting. Our next conference will be in Blanchardstown Town next year on the 8th of May, with the workshops probably either side as we have today, as we have done this week. We're going to do something on financial education. Don't think anyone from Swoboda knows that, but I had an email exchange with Dave McCauley and Dave Malone about the importance of financial education and some interesting things that are going on in Ireland, and I think that will be good to share some of that. Obviously, financial education is so important to us as credit unions. And we will be doing a lot of engagement through United Vision next year, so for British credit unions, watch out for that. The agenda, next up will be Paul Jones and Dave Malone giving you a kind of canter through some thoughts on where our credit union movements are right now today in Britain and Ireland, which will hopefully generate some thoughts about where we need innovation. Our theme of the day is innovation, and we hope that, coming out of what David and Paul say to you, you'll be thinking about what needs to change. Then we're going to have a panel, which Caroline Demansky is going to facilitate with 3 of our corporate member suppliers, who've worked with credit unions, who worked with you guys, some of them for a long time, some of them more recently, and with some thoughts from them on what we do with innovation, how we do we do it well. After the break, so there'll be a break to mill around, you have to be back at 5 to 12, we will start at 5 to 12. Molly Harris from New Economics Foundation is going to do a facilitated session where you guys are going to actually do some work thinking about innovation, which we will use, and we will be using that as part of our United Vision project. Then after lunch, George from, I'm going to do a plug after lunch actually, I have to be open about that. We're going to talk about I4, which is our new incubator initiative. And then George will talk to you about the US and his experience of how US credit unions are approaching innovation. And those of you who've seen George before will know how interesting he makes that and how he actually does understand the differences between the US and here. We're not suggesting we're suddenly going to be as big as those guys. And then we're going to conclude with a really interesting panel of fintech entrepreneurs who are going to give us some of their thoughts about how they're generating innovation, bringing innovation into our sector. And then Paul will wrap us up, and we will finish at 4. We know it's a Friday. We know you're travelling. I'm getting a wave at the back from Sheila. Right, sorry. Yep, there's one at the front here. There's a couple here, and at the back over there. Sorry, everybody, for that. There's one over there by Paul. Golly, really is standing room only. I just want to put a thought in your head, and we'll be going to talking about innovation today by talking a little bit, but just briefly talking about risk. And by risk, I don't mean risk frameworks. I'm not going to talk about risk management, risk controls. I mean the taking of risk. Innovation will require, if we are going to innovate, if we think we need to innovate, innovation will require us to take risk. We will require us to do something we haven't done before. We will not have control about what happens. So just a couple of kind of analogies, really. The first one is, we're organizations with a mission. We are stewards of this precious thing that we've been given by previous generations, all of us as directors, leaders of these organizations, workers in these organizations. We've got this precious thing, and we know that we are carrying it to hand it on to the next generation. But that means we probably don't move very fast. If you're a curator of beautiful, precious things, you don't run very fast. And maybe you're very worried about dropping this thing. So what does that mean for whether we move at all? Because we're very worried about holding this thing. I don't know if any of you George, have you cycled through Vermont? Yeah? The covered bridges of Vermont. Vermont Tourist Board has not got lots to shout about. I mean, it's a lovely state, but, so these bridges are a big deal if you go to Vermont in the US. And they are very lovely. But they're very old. So if you're the custodian of this bridge, which enables people to get from one place to another, it's really important. If the bridge isn't there, they have to go 20 miles round. You're kind of thinking, well, I don't really want to, I can't shut this thing. Do you shut this thing down? Do you repair it? Do you change it? Do you make it better? Or do you think, well, let's just hope, because actually anything we do is going to cause massive inconvenience. Any way we refurbish this thing that looks beautiful and old, people are going to be unhappy about. So probably best just to leave it. Just to leave it and hope it doesn't fall apart. So adding that into then this idea of incentives. So we know that if we were private businesses, we would have owners who have a very clear set of objectives in terms of the return they expect. And they expect the board to oversee the delivery of those returns. They expect a non-executive team to have the right dialogue with the executive team so that the executive team puts the right pressures in the system for the organisation to deliver those returns. And everybody in that is incentivized to achieve those outcomes. Financially, or that's the carrot, or the stick is potentially, the owners say to the board, well, if you can't deliver this, we'll get a board who can. And the non-execs to the execs, if you guys can't deliver this as an exec, then we'll find an exec team that can. And that's quite clear. And what that means is that people have a very clear incentive to take a risk, because it's quite probable they can't deliver those outcomes without taking some risk. I'm not advocating for that as a model, but I'm just presenting that as a chain of incentivization. And I'm wondering what that parallel is for us. Which director here has found that the owners are putting severe pressure on them to deliver different outcomes? Anybody? I've been a director. Don't think we have. Our AGMs are great events, but they're not the place where the members say, guys, this dividend is not good enough. I'm going to vote you out if you don't deliver. That's not the way we work. So what's the pressure on the board to take that risk when they're carrying that precious vase or they're stewards of that valuable bridge? And then the executive team's probably not getting heavy pressure from the boards, because that's not the way we work, to hit those numbers, guys, hit those numbers. What's the pressure? They're not going to get the $500,000 bonus if we get the 3% dividend, or if the organisation is 3 times as big in 3 years' time. So where's the incentive? I guess the incentive comes from within us, that it's the right thing to do. That if we don't take a risk, our organisations will fail, or the people of our community will not get the services that we want them to have. But that's quite a challenge, right? Because at the same time, you're worried. We're in a regulated environment. The regulator's saying, control your risk, control your risk. And you've got this precious thing. So how do we make sure we take a risk? I don't know the answer to that. I'm going to leave you with that thought, though, because I just feel that as having someone who's been a board director, have I felt the pressure to take a risk on behalf of my members, or have I wanted to take the safe path, which is not to do anything very much? Maybe the next board will fix that. Let's leave that one there, then. So I'm going to, with that in mind, I'm going to invite our first speaker up, Paul Jones, Director of Swoboda. And Paul's going to take you through some findings and some thoughts on our United Vision project, which is to develop a vision for British credit unions in 2035.
Okay, good. Well, it's great to be here. Sorry about that. The problem has been I've had a bit of back pain recently. Just came on last week and anyway, never mind that. I'm here, and I'm here to talk about our Credit Union United Vision project and the initial findings and reflections on this. Now, I know quite a lot of people in the room know who I am, and they'll remember me now, the guy that slipped on the stage. My name's Paul Jones, and I'm an associate professor here at Liverpool John Moores University, but also, as Nick said, a director of the Swoboda Centre. But I'm also an activist as well, and a very proud member of the board of directors of Enterprise Credit Union here in Liverpool. And so, and I've also been involved in credit union research and development for an extremely long time. And I know very well, from my own personal experience, that credit unions everywhere, in this city, throughout Ireland, throughout the rest of Britain, anywhere and everywhere, they're doing amazing work for their communities and the people, their members. We know that, we've seen that, and we understand that everybody is working hard to develop the credit unions and the services we give to people. You know, as Paul said in Knowsley, the credit union in Knowsley is doing great things for the local people. But this project that we've been undertaking with the New Economics Foundation, and Molly's here with us, and funded by the Aviva Foundation, this project has been to look seriously at where we are, not as individual credit unions, not as Enterprise, not as Knowsley, not as Manchester or any other credit union, but where we are as a sector. Where are we globally together within the population of Britain? And so we've been undertaking this project. It's a research project with multiple numbers of methodologies, including surveys, statistical analysis, interviews, and looking at the literature as well. And so what I'm going to present really is the findings so far, and it's only interim, we're only beginning, the findings so far of this particular project. Now, some of the findings are challenging, but I think one thing I need to say is that these findings are coming from you, from the people. It's not me and Nick's take on it, it's what we've learned from what we've been able to discover. So I'm going to start with the headline. The headline is, this is like the end, this is the kind of last slide, but I thought we'd put it up first so that we can kind of get an idea about where I'm going. And the headline is, as we currently constructed, as a sector, not as individual credit unions, remember, we're not actually going anywhere fast, nationally. And actually the impact, and we're very interested in impact, we know that there's a political context at the moment wanting the cooperative and mutual sector to expand and grow and serve a much large proportion of members within our society, number of people in our society. And so there's a great kind of hope and aspiration and expectation that the credit union sector as a whole will deliver. And that impact to deliver, really, as we'll see from the end of this presentation, depends on more credit unions having ambition and resources to implement necessary change. It needs more credit unions to get in a fast lane, into a fast lane. I'm going to start talking about some of the statistics. We were lucky and very grateful, in fact, to the PRA that they gave us some of the data on our credit union sector, which has allowed us to have a look at the data, what it's telling us. The first thing I've got to say is that we have two credit unions in our data that are outliers. So many people in the room will know who these are. I won't mention who they are, but we have two credit unions that are very big and have grown big over a number of years, and they have 25% of the assets of the British credit union sector in just two credit unions. They have a business model that's very different to the ones that we have in Enterprise and Knowsley and everywhere else, and they are so different that we've taken them out of the statistics. So that's just the kind of, because sometimes when you look at the global statistics, it kind of gives you a, it looks better than it really is. because of these two credit unions in the numbers. But what we find here is actually, when we look at the assets of the British credit union sector, with those two removed, that actually asset growth is essentially flat. You can see here over the years, from 2016 to 2024, how it was going up, 2020, then after that, it's kind of stable. Not going down too much, a little dip in 2023, but in terms of asset growth, we're not really going anywhere. In terms of growth and expansion, globally, all of us together. And there's another view of our modest asset growth. This is when you look at the growth of assets, the median, the one in the middle, by credit union size. You can see down here that under 5 million, they've gone from 1.1 to 1.8, so there's a little bit of growth there. But you go to the others, the 10 to 50 million total assets, 15 to 16, there isn't a lot of growth. A little bit more growth in the larger, over 50 million asset credit unions, but we've only got, as you can see here, in there, we've only got 7 credit unions in that statistic. So the message is, asset growth is slow. I'm going to have to watch the time. Could you give me a shout when we're halfway through? All right, okay, well, that's great, isn't it? Shares? What about shares? Shares are flat as well and beginning to dip. A little dip, you can see from 2022 to 24. We're not massively taking in a lot of the deposits from British households into our credit union sector. When at the same time, as you see that's a little bit on the side, since between 2019 and 2024, household deposits into the UK financial institutions in general, banks and everywhere, grew at a level of 11.2% per annum. Also add in inflation. It's not great. Our shares are dipping, we're flatlining as well. But loans are growing. We still have a healthy demand for loans in our sector, which is, is positive. People still want to borrow from credit unions in general, but they borrow mainly from some credit unions. I don't say they're larger because we haven't got the statistics about how big they are here, but some credit unions are making the rest look better on loans to shares. Here you can see on the blue line at the top, so the average gross loans to shares across the whole of the sector is around 79%. Now, I know our Irish friends from our Irish credit unions will say, isn't that brilliant? Well, it is brilliant, except you look at the red line, which is the median of all the credit unions, and you'll see that that's 49%. So there's over half of the credit unions are not lending that much, but built up by other credit unions. So not every credit union. So there is differences within the sector. Capital has strengthened, but given the time, I'm not going to go into that one. But we're going to do a lot on capital in part of our project, looking at the need for capital, both to support growth, because if we were lucky enough in enterprise to take in £5 million worth of member savings from the city when we open our new branch somewhere or other, it'd floor us, because we wouldn't have the capital to sustain it. We'd have to be giving people their money back. So we need capital both to support capital adequacy, to support growth, but we also need capital to have the right operations and systems in place to develop. We'll do a lot more on that. Now, that was the statistics, which were interesting. They're not depressing, they're interesting, and they give us a challenge. We also went out and asked people to complete a survey for us, and we had 226 replies. This survey is still open, by the way, and if there's anybody in the room who's not done the survey, please do it, we might get 300. But these are really interesting, what people had to say. I'll have to look down here because the screen's very small. Don't look back. So we asked people about their ambition and their confidence within the credit union sector. And all of these were credit union activists. And you can see that we asked CEOs and everybody separately. So how confident are you that your credit union has the robust strategy to significantly grow in members and assets over the next 5 to 10 years? About a third of everybody. 38% of CEOs and 31%, yeah, they believe that their own credit union, it's only a third, has got the wherewithal and the robust strategy to develop. So that's about their own credit union. Then we asked about them in general, because we're interested in general at the moment. How satisfied are you in general with the impact and reach of the British credit unions within the financial marketplace? Satisfied or very satisfied? Only 8% of CEOs and 13% of everybody else. Do you consider that the British credit union sector in general is now stronger, more resilient and more sustainable than 10 years ago? So the people who said significantly stronger and more resilient, 5%. And that's kind of strange, because actually the credit union system in Britain is more resilient and stronger. You can see it from credit union, but in the very complex environment in which we operate, cost of living crisis, competition, digitalization, all the kind of things that's going on, people have got the kind of feel that maybe we're not that as resilient and as sustainable as, we should be. How confident are you that the credit union sector as a whole could double in size, in members, in assets over the next 10 years? And we know that that's the government aspiration and call to us. 14 and 16%. But do you believe, do you believe that the movement should be seeking to be bigger and to expand its impact? Well, yes, we're all on board. We want to expand and develop. 68%, nearly 70% of everybody wants to get bigger, even though the confidence isn't quite there that we can do it. And this is why we're doing this project. We're doing this first bit about where we are, but as we go through next year, we'll be looking at, the way to get there and the roadmaps and what needs to change and what we need to do. So, now to the interviews. And we interviewed quite a number of people who are in this room. So, it's you who was telling us this. We'll see a few of them are smiling. Right, what people are telling us? Well, the first thing that people are telling us is that things have changed. Our British credit union system, is increasingly professional. We've professionalised them in management and operations. It's not like it was 25 years ago, even 10 years ago. Things are changing. Remember, people don't know, but some people in this room will know that I did a similar project 25 years ago in a British National Survey of credit unions and where they were going. I mean, the difference is absolutely light years away. It is just so different. We have professional management and staff in most of our credit unions now. Technological advances, most of our credit unions are now, apps and, technology has changed. Enhanced range of products and services, but still mainly, we concentrate on savings and loans. But even savings have changed a little bit with a move to more interest-bearing accounts. We've got better governance. We've got more professional boards all over the place. But it's not a problem that's been solved everywhere. And people said that there was challenges still in that area. There's a very healthy move away from grant dependency, particularly in England. And it was grant dependency at one time that kept us quite small. But a mixed performance across the sector. A minority of credit unions are thriving, others are ticking along, and others are struggling. So we've got these three lanes, the fast lane, the middle lane, and the slow lane. In each of those lanes, credit unions are doing great things, but the fast lane is a smaller number of credit unions. But we've got competition, and everybody knows about these people. Stream, wage stream, salad money, they are around. They've got technology, they've got expertise, they've got recognition. And we've got some big challenges coming our way through the financial inclusion strategy. We're going to make sure that we're able to respond and we're not overtaken in the fast lane by these other entrants and CDFIs. What people told us that was holding us back? Invisibility. I'll say this very quickly because everybody knows it. Invisibility. Credit unions are invisible. Lots of people still in Britain, unlike in Ireland, don't know what a credit union is, don't know what it's about. Lack of ambition, an entrepreneurial leadership. Ticking along's okay. And ticking along is okay, but the ambition to move into the fast lane is not everywhere. Governance issues are still an issue in many credit unions. There's also a sector split between digitally ambitious credit unions and more traditional models. Technology is good, but not good enough in comparison with the competition. We also have a lack of capital, which I've already mentioned, to support and to invest in and support rapid growth. And of course, in the sector, we have multiple representative voices, maybe giving different messages to government and stakeholders, and we can see that in the room too. How do we enter the fast lane? Well, I'm going to have to speed up a little bit. I'm looking at this clock here, so I'm now in the fast lane. So the fast lane, how do we double the sector? It will demand bold and entrepreneurial ambition. It will demand, if we want to get in the fast lane, we could just tick along, and a lot of credit unions will want to remain small in their local villages or wherever they are with a few thousand members, and that's maybe great. But if we want to make this big impact on the national scene, we're going to have to restructure and rethink our business models. We'll have to transition to digital first. We'll have to AI integration to streamline member interactions and quality assurance, increase professionalism and competent governance. But this presents us with a dilemma. Presents credit unions with a dilemma. Because to get in the fast lane, maybe things that we've done before, we can't do in the same kind of a way. And one of the things that keeps credit unions in the slow lane or the middle lane is often that personal, deep interaction with members. Getting in the fast lane and becoming digital first, as one credit union told me, one of the biggest credit unions in the country said, we are now digital first. What's the payoff? What's the trade-off there? And many credit unions will choose to stay in the slow or middle lanes. But even there, they will need to think about their relevance and their stability and their sustainability and what impact that will make on them into the future. And are there risks associated with staying in the middle and slow lanes? So the question is, will growth towards doubling the sector and making a significant national impact really only come from credit unions in the fast lane? That's the question. Not answered yet, but that's kind of thing. The fast lane demands a shift in imagination and practice. It demands serious investment, organisational efficiency, which I think George was talking about yesterday at the dinner. It will involve consolidation, which is mergers and transfers of engagement, and collaboration. But collaboration really is much more effective between credit unions that are larger and stronger and more sustainable. It will demand a focus on profitability, generating income for investment and growth. It will involve a switch for many of our credit unions to promote savings mobilisation, because unless our savings grow, our loans can't grow. And so, issues like paying interest or dividend on savings become more important. A focus on better use of data, external investment into capital, entrepreneurial and bold leadership from board and executives, and I know there's a lot of work going on in that area. And then we come back to the big takeaway, which is the conclusion, which I put at the beginning. That as a sector, now, I want people to realise that because I know there's such good work in individual credit unions. But as a sector, we're not all in the fast lane as yet. We might not all want to be in the fast lane. We might want to be in the middle lane or even the slow lane. But if we're going to achieve significant relevance on the national scene in the financial markets of this country, we're going to need more credit unions to get into the fast lane. I'm 1 minute 45 seconds over, but I think I'm allowed that, given the trip up at the beginning. So there you go. That's what we know so far. It's not the end of the story. And what we want is much more engagement and input into this project, which lasts for about another year or so. There we go.
Thank you, Paul. Well, so we're throwing a bit of a gauntlet down there, and I guess one of the things that British credit unions might think about is, if we, as Paul says, about being relevant in a more impactful way, is the Irish movement is a bit of an inspiration there. We're a very long way away from that in the British movement in terms of awareness and reach as things stand. But why not be ambitious? And so, with that in mind, I'm delighted to welcome David Malone, the Chief Executive of the Irish League of Credit Unions, to talk to us about the Irish credit union sector. And then if we have some time before the next session, we'll hopefully get a couple of questions from you for David and Paul. Thank you, David.
Great. Good morning, everyone. Thanks a million. Delighted to be here from Ireland. I was thinking of Paul's comments earlier on. I'm a keen football fan. I definitely thought there was 2 football teams around here. It's Everton and Tranmere, isn't it? Well, good morning. I'm delighted to be here anyway. I just want to share some perspectives here from Ireland, I think, in particular. And I think what's very interesting listening to Paul this morning is the parallels, really. I've been in Brussels this week with European credit unions. I was with ABCO representatives yesterday in London, and just the similarities between credit unions across the globe. Perhaps we're at different stages of development, but actually we've such similarities as well, and I think that's a point to note. Just to share the Irish perspective, I'd say, first of all, in Ireland, our government made a very clear mandate back in January. And in January, they stated clearly there was a commitment to draft a 5-year strategic plan for the credit union sector in Ireland. And that hasn't really taken great traction at this point in time, to be frank. And we took the bull by the horns in the league, and I think our credit unions who are here today would absolutely expect that of us from a thought leadership perspective. So we had a very significant sectoral strategy workshop only 6 weeks ago. So I'm going to share some of those aspects with yourselves today that came out of that workshop itself. And before I do that, though, I do want to touch on some member data. Rather than looking at the credit union financial data, I want to thank the Homes team in Marketplace who have provided and helped us with this data. And it's about a view of membership in credit unions in Ireland. And to put it in context, this is based on 60 credit unions, 1.8 million members. And they've looked at the activity of members in credit unions. And activity is defined as having a transaction. And they've looked at it in 2 time scales, 30 days and 90 days. And they've also looked at it in 3 regions in Ireland. So we have 3 regions. Dublin accounts for about 30% of the Republic of Ireland population, so looked at separately. Then we've got the rest of Ireland, and we've got Northern Ireland as well. And I think what stands out from that data quite clearly is, first of all, the average inactivity under the 30 days benchmark is quite consistent among those regions. It's about 55%. And in 90 days, the average reduces to about 50%. But it's really interesting to look at that and to interpret that data. There's two aspects, I think, that stand out to me. One is, first of all, those members have trust in the credit union. They have trust, they want to be members of the credit union, which is really positive. But there's also a huge opportunity now for us in the credit union sector to collectively look at activating those members as well. There's a huge opportunity to do that. And the next slide is looking a little bit further on this. Who are these members? Let's analyse that a bit further. And we're looking at it in 2 particular aspects. One is, first of all, about affluence. So basically, the general household income that's coming into those families. And there's 5 different bandwidths looked at. And in particular, you can see as we migrate up the chain in terms of household income, the activity, and that's the activity bar there in green, decreases. We're down to actually 46% for those in the highest affluence group. Now, the highest affluence group might suggest that we're talking about significant salaries, but actually the household income we've looked at here is about 80,000, 90,000 euro. So it's, you know, it's a decent income, but it's not massive either. And it's in terms of looking that we can see that certainly the activity level is declining as we migrate up there. But I think what's really more interesting is looking at the generations themselves and looking at the youth and age profile in particular. And if we look at this, I suppose, first of all, if we look at Generation Alpha and let's say the silent generation, I won't say discount them, but I would discount them slightly. The silent generation, like my father's age group, is over 80, and definitely the Alpha is under 13 or so. But I'd be very interested, really, and I draw your attention to looking at the three in the middle in particular, particularly looking at Generation X. About 60 to age 45, their activity level is about 56%. Then it migrates down, though, as we get down to millennials, who are in that 29 to 45 age group. It's dropping. And then we get down to Generation Z, and my eyesight is not great anymore. I think I need glasses. But basically, you can see it's dropping even further. We're down to below 50%. And there's certainly something in that. I think that's very pertinent where we can see, and it's probably not a surprise, but as we migrate down the age curve, it's quite clear that the activity level does drop. And that was a useful context for us as we designed this sectoral strategy day. And we brought together about 120 credit union leaders in the Republic of Ireland, both CEOs and chairs. And we looked at what we call play to win strategies. So we looked at 4 questions around play to win. And we purposely did that with our strategic consultant. Play to win is not about playing not to lose, it's about playing to win. So it's very much focused on the offensive rather than the defensive. And it changes the whole manner of the conversation, I think. So I'm going to just share briefly, and I'm conscious of our time as well, just a few pieces around, first of all, the first question, which was, what does winning mean? What does winning mean for the credit union sector? I was really interested in this discussion because this really got into the heart of what the purpose was of a credit union. There was really passionate discussions in the room around this. And there was certainly an answer here of what winning doesn't mean. Winning doesn't mean becoming a bank. That was quite clear. Winning, however, it seemed to me, and generally consensus and feedback was, it means about being a community enabler. It means about being first choice for community finance. It means co-creating solutions with our members in communities. But it's much more than just being a financial service provider. That was really loud and clear in particular. The other message that was strong there was around consistency. And it probably came at 2 different levels. It came from shining the light on us and other credit union representative bodies about having a clear, consistent message at a national level and providing thought. That was absolutely clear. The other piece about consistency, though, was about at the credit union level and about our offering of products and services, standardisation, consistency where possible in those, and perhaps selecting certain types of products where there is a consistent offering, but also a consistent experience as well for the member. So that was very much where we were in winning. But the next question then was, okay, we're clear maybe potentially, we've some concept here of how we're going to win, but where are we going to play and win was really the next question. And there's a couple of aspects to this. One of the CEOs in attendance said they were very clear how we're not going to win. We definitely won't win if we try to do everything, everywhere for everyone. We've no chance of winning then. We're going to lose. However, like all organisations, our strategic resources are limited. We've got to focus particularly on where we have the most collective power to really alleviate and make a real community impact to our members. And that's where the focus was in particular. And there was a very interesting discussion in particular around the product focus. And this is not resolved yet, to be honest. There was a view in some of the room that we should be offering the full suite of products and services, of financial services, the whole suite across the board. We should do everything. But there was also another view, perhaps, that what we should do instead is we should be prioritising, in that word of our credit, lending. Lending should be our priority. That's where we should be focusing and prioritising our resources, and we should focus our impact on those resources in particular. That's where we make the maximum impact, particularly in terms of mortgages. Mortgages is a growing part of the Irish credit union portfolio. About 10% of our lending is now in mortgages, and our loan book in mortgages has doubled over the last 3 or 4 years. So that was some of the insight there, but certainly that piece around that in particular, around the depth of product service offering, versus perhaps a more tailored focus in particular. I'll just move on to the next slide. The next piece then was around what gives us the right to win. And this garnered really good discussion, I think, with everybody, particularly in the room. We had great discussion on that. And there was great obvious pieces here around our trust, our relationships. Just yesterday, the Irish credit union sector was voted number one in terms of sustainability impact in Ireland. And that beat all the other financial institutions, all the other institutions in Ireland, even the National Post Office, which is massive national investment. We beat them all. And we also top still customer experience and also in terms of reputation. We're number one for those. So we have a great opportunity and we do have the right to win. We have the skills and goals to do that. I think what's really important as well, though, is the cooperative values and that piece around cooperation. Our President, Brendan Jenkins, is here today, often mentions particularly around the concept of there's no them and us, there's just us. And I think that's an important piece to really realise these benefits. We often use that word collaboration, but it is actually about working together collectively, really, that really we have the maximum impact. And particularly as well, that community impact. We in the League are going to be launching a community impact report in the new year because we want to demonstrate the real community impact that credit unions have. We probably haven't done a great message nationally of communicating that in the past, and we want to do that more. And we're going to be issuing that. In particular, we've noted that we in the sector give about 9 million of donations, bursaries and subscriptions and community impact and community funding out to the local communities every year. That's multiples of what the banks do. So there's a real disparity and difference there. So we're in a strong place and we have the strong capabilities to win. But then the final question, I think, was really the key one. And this is the last one. This is where it is tricky. It's about the capabilities, the skills and resources needed to actually deliver. And I think I can see real parallels with Paul's presentation here. The number one aspect was clearly technology. Technology came out loud and clear. That digital piece, everywhere in the room in this workshop, that was the focus. And there's a real need there, as you can see on this slide, for these capabilities, skills and resources needed, that we do work together. We have shared services. They're not just something that are nice to have or they're efficient. They're really essential for us to drive forward on that. The other piece that really drove out as well was in terms of that concept of the human offering, which is really important, but also reconciling that to the digital offering and scale, and ensuring that we have a clear strategy on both and that they're coherent together as well. I'm also looking forward really later on to hear all of our speakers, particularly Jen and Joss, around financial partnerships with fintechs, because I think that's something, you know, the credit union sector should be potentially considering and looking at as well. That is a potential avenue, particularly as we realise these capabilities, the skills and resources. There is huge competition in the Irish credit union sector, financial services sector, particularly in terms of Revolut, who now have over 3 million members. 3 million people use their current accounts. So just like Salad and the other providers in the UK, there is that competition as well. I want to touch on one final piece, I suppose, because I'm sure all of you are looking at all this feedback. It's interesting, but where do we go from here in particular, I suppose? So there is a couple of next steps for us in the Irish League of Credit Unions and a few aspects to it. The first piece is around we are going to bring forward a strategic position paper from the Irish League of Credit Unions based on the feedback we received. But it's not just going to be a collation of the feedback, because that's the feedback there, but that's just a collation of feedback. We've done that before. Instead, what we want to show real clear leadership and be bold and brave around that in particular. So we are going to issue that draft to our credit unions, and we'll be happy to share it with the colleagues here in Swoboda as well, to get their feedback in terms of the thought positioning, the thought leadership, and also the strategic direction, potentially, we are looking at going based on the feedback we received. And we'll give a period as well, like a consultation for feedback from credit unions on that. And that paper will go out in the coming weeks. And then we will finally issue a final paper into the Department of Finance, setting out our strategic position paper, which I hope will be a really key input to grow momentum in terms of delivering on that programme for government commitments on the strategic plan with the Department of Finance. So I think I'm 1 minute to go, so I did well. I was definitely in the fast lane. So listen, thanks everybody, and just happy to hand over to Nick now, if that's okay. Thanks.
If your brains aren't fizzing after those two, then go in there and put the daytime telly on. I think there's some really interesting messages coming out, both of those, some differences and some similarities. Any of you who were with us last night for the dinner, all those conversations we were having about relevance, so much of that emerging out of this. Now, I want to take 5 minutes for some questions from the floor. I'm conscious it's going to be just a challenge to get this microphone from me to wherever you are. I do apologise for the lack of seating and of you guys at the back. We didn't expect you all to turn up. This is the penalty for success. I have a hand up over here, so everyone else, think about your question. We've probably got time for 2 or 3. Perhaps you could introduce yourself as well.
Yes, of course. Yes, Robbie Mockery, Dalmuir Credit Union and many other things, including the Library of Mistakes in Edinburgh, where we are interested in doing work with credit unions. But the question I've got, which I misinterpreted, Paul, when you started. I thought that you were saying you wanted more credit unions, not just credit unions to do more. And so I think that one of the interesting questions which comes out of this, and you actually started off with the 2 credit unions that you had to take out of the sample because they've expanded so quickly. One of those, the Scottish one I'm thinking of particularly, was really a start-up 10 years ago formed from the merger of 2 small credit unions. So what I'm thinking is, how do we, not necessarily how do we encourage more like that, yes, but how do we encourage more credit unions so that there are actually more opportunities for development, rather than just saying, let's start with the credit unions we've got?
So, Robbie, you're saying about the creation of new credit unions. That's a good question. I don't know how many new credit unions there are in the pipeline. I actually haven't come across any recently. I think, actually, just think of our own city here of Liverpool. I don't think we need any more credit unions, to be honest. We've got 10 credit unions in the area. Maybe some of those will merge over time as years go on. Time goes by. But I think that credit unions getting into the fast lane is the most important thing, rather than the creation from scratch of new credit unions. But as you say, in regard to that credit union in Scotland, it wasn't quite a new credit union. It was taking the model of 2 existing credit unions and completely re-engineering the model in a way that has there are things that we can learn from that, but there are other things that we are concerned about and worried about in that. One of the big things that we did learn from that kind of rapid expansion of those outlier credit unions was the importance of encouraging people to save by offering interest on savings accounts. Something we've adopted in our own credit union now, that people, and that, giving that certainty that we will give, a 3 or 4, 5% return on your savings brings the money in. We also learned from those credit unions as well the importance of technology, because that platform, whatever we might think about it, behind those credit unions is sophisticated. It's modern. It does the job. But I'm not going to go into the worries. That's not a purpose of today. But I think it's more and more about our existing credit unions developing in the ways that I did explain, developing a way that takes them into that fast lane, in a way that conforms, though, with our cooperative and credit union values and principles. That's just a given, that we are committed to being cooperative financial institutions. We're people helping people.
Just briefly, I agree totally with Paul. I think the strategy is really helpful as well, because I think it's maybe not about more credit unions. In Ireland, we've had consolidation. We still have more physical locations than all the banks combined. So it's about actually probably serving the communities and not losing that community impact, in towns and villages, being there as the kind of community hub. And I think the advent potentially of credit union service organisations, I think, could be potentially very helpful. They can pool resources, share scale, and help more credit unions to offer a wider range of products and services, or reduce costs as well, while maintaining that community-focused access. So probably complementary rather than replacing, I would expect. And that's what I hope comes out of our own strategy as well.
Hi there, Nigel Roberts, Serve and Protect Credit Union. Paul, you talk about the fast lane.
Yes.
I'm concerned that when we're in the fast lane, are we on the M25 going round in circles, or have we actually got a destination where we want to get to?
Yes,
because there's got to be a consensus of what credit unions. We've got to keep the principles of cooperative principles, but do we end up all being nationwide? Because that is where if we want that utopia of being a really relevant financial institution, we end up being bigger, but we will have pressure on those principles.
Well, I think you're right that we have to maintain our cooperative values and principles. We didn't speak about that in my presentation because I take that as a given, that actually that's what we're committed to. We're also committed to, serving our members, and the fast lane is just an analogy. We don't intend to be going round and round the M25 or the M60 around Manchester. No, it's an analogy about how, in what way we can serve the members in our common bonds at the moment much more effectively. Take, for example, the Liverpool credit unions. We have the whole of Merseyside, which I don't know what the population is there. What's the population? I can't remember. But we have a good penetration. I think it's about 10%. 8% in Merseyside. We could serve 16% maybe in Merseyside if we could get ourselves together into the fast lane. But the fast lane is just an analogy, really. It's just about saying, we need to kind of change the business model to make sure that we reach more and more people with the services and products that we know that people value and want. Of course, we've got to make sure that they are the services that people value and want. And that actually we can do that without losing our cooperative values and principles. On your mention of the common bond, do we all have to have a national common bond? Of course, one of the reasons why these two outliers have developed so quickly is they have been able to engineer a national common bond effectively. But I wouldn't imagine that's not going to happen for our credit unions or most of the credit unions that exist. I don't know if that's the right answer, but that's how I... Yeah.
We do plan, don't we, in the United Vision projects to actually try and get that destination discussed.
Yes.
So that we can understand where we need to collaborate, what the priorities are, and that kind of thing.
Because at the end of the day, members want, isn't it?
Yeah.
And we're all moving to away from certainly we are. Our members want. Sorry, our members want a guaranteed return on their savings. They want to know what it is.
We want more of our members to save with us.
Yeah.
Because our members save elsewhere. It's obvious. They are saving in maybe the building societies or in the banks. They're saving elsewhere. So that's one thing we want. We want our members to trust us enough. We want to give a good return on their savings so that they save with us as their primary, deposit taker. So I guess that's one thing we want.
Yeah, but that's happening because our experience is when we set a attachment to shares return, they're bringing their money from those institutions to us because we offer a better return.
I'm going to jump in. I'm going to leave you with the last word there, Nigel. So, thank you very much. David, did you have anything to say before we move on?
I think it's a great analogy used. I think it's having that roadmap to the destination. I think it's great what you guys are doing because I suppose in Ireland, credit union service organisations have already started a couple of years ago. We probably didn't have a strategy though for the sector. And I think the way you're thinking is developing the strategy. You have an opportunity with a greenfield site nearly to get the CUSO set up in the right way, but underpinned by a clear strategy, which is the destination. I think you're really focused on. So that clear destination, that clear roadmap, you could develop that in the strategy, and then you have a coherent ecosystem. So I think you're doing it the right way. I think.
Fantastic, great. Well, thank you ever so much, David and Paul. Can we give them a big round of applause? There you go. You want a hand? Yeah. So I'm delighted now to welcome a panel which Caroline is going to chair, a panel of providers to credit unions who are going to give us some thoughts on their experience of working with this movement on change and innovation. I know Caroline's got a bunch of very exciting questions for them. Do you want to, or we can, yeah, why not? When you get a mic. We're going to give you handhelds. Yeah. Okay. You get those on the stage. Oh. Thank you. And can you hold that one and go to the back?
Yeah.
And then you take that. Hi. Could we switch that one off until there's a Q&A? Yeah. Cool. Hi, Paddy. How are you?
How you doing?
Thanks for coming. Good.
I was only delighted. I only realised that the Everton headquarters are on a different floor here.
Yeah, that's right. While we're getting Caroline mic'd up, I should remind you all, there's a handout on your tables. It's got information about the conference. It's got information also about, on one side, it's got information about the incubator project I'm going to talk about this afternoon, and views from suppliers as a survey. And on the other side, it's got the conference program. So do use those QR codes. Right. So I think we can give you, I'm sorry, we're probably slightly behind time, but let's go for 30 minutes. 30 minutes, you can see that? Is that all right? Great. Okay, over to you, Caroline.
Got a lot of questions for 30 minutes. Anyway, good morning, everyone. It's all very quiet. I spoke to a few jaded people, so that's good morning. Anyway, I am Caroline Demansky. I am the Chief Executive of Number One Copperpot Credit Union, and I am also the current chair of Swoboda Research Centre. But we're not really here to talk about me today. So we are here to talk about innovation, and we're here to talk about real innovation, not just buzzwords. We have got some very different people on the panel today. So we've got Progress Systems, who are a platform that many of you actually operate on. We've got Singlify, who are a new entrant to our market. And we're also joined by the Solution Centre, who have helped many credit unions with their transformational journeys. So before the panel introduce themselves, what we really want to talk about is what's possible right now, what's holding the sector back, and what credit unions need to do differently if we want to change faster, or as Paul has so eloquently put it, get into the fast lane. So, Jan, let's start with you. Just tell us a little bit about Progress Systems and also what part of the platform you wish credit unions used more.
Okay. I'm Jan Howard. I'm the Chief Operating Officer at Progress. We're a core provider, obviously. It's an established platform that's been running for over 20 years and evolved. We provide the core platform as well as the digital services, as well as a cloud-based API infrastructure for people to plug into our core. So those are the services that we provide. I heard Paul mentioned the fast lane, digital first. It's completely our strategy and has been for the 4.5 years since I've joined. We've also managed to grow the business 30% in that time frame by focusing on digital first, by focusing on API. And I think actually API parts of our business are over 40% of our business today. In terms of what do I wish people use more, it's a difficult thing because we're a large platform. People tend to use the bits they need. But I think in retrospect to what we were hearing today, using more of the digital platforms and maybe more awareness of the API integrations that we're able to offer is probably the areas that I would focus on.
Thank you. Martin, so please introduce yourself and Singlify. And if you could tell us what problem you saw that made you want to move into the credit union sector.
Thank you. Yes, Martin Rooney. I'm the co-founder and CEO of Singlify. We have been around for about 7 years, but only recently entered into the credit union sector Our background is more in inclusive finance with microfinance and social impact investors. That's where we established our platform. We now have over 30 customers using Signify as our core platform, but now moving into the credit union sector. And our journey started about 2.5 years ago into the credit union sector, triggered by some research done by Fair for All Finance and Inclusive Finance Center, which surveyed the sector, of which came some conclusions around the potential for core systems in the credit union sector and how much that could galvanize growth, and also how much interest there is in innovation in the core sector, in the core infrastructure, combined though with the reality of limited budgets. These are not, they're not banking budgets. There's limited budgets for these platforms, and that's where I think we felt the attraction to the sector, because we only focus on inclusive finance, and I think we are developing a really top-end back-office system for an affordable budget. So I think those two combinations of the potential of core and what core platforms can do. We build our platform fully on the Salesforce platform, so CRM-based, combined with the reality of smaller budgets. So those two things are the two problems I think that we tackled and that attracted us to the sector.
Thank you. Cahal, please introduce yourself, the Solution Centre, and do you know what would be really good if you could just tell us one of the most interesting gaps that you've bridged between service providers and credit unions?
Yeah, sure thing. Hi, good morning, everybody. My name is Cahal. It's great to be here. In terms of my own organisation, I would work for the Credit Union Development Association. So that's a representative body in Ireland. That was established back in 2003 to enable and inspire sustainable development between Irish credit unions. Within that, we have a unit called the Solution Centre, which I head up. And the Solution Centre, our job is to take the strategic aims and ambitions of groups of credit unions and turn them into executable solutions that can be delivered then commercially between those groups of credit unions. So I suppose I come at it from a very different point, maybe that to Diane and Martin. We tend to play a bridging role. So I sit maybe between credit unions or groups of credit unions and the vendors. And what we try to do is we try to align groups of credit unions, we try to define specifications, and we try to make sure that we can achieve some form of standardization when we're looking at different projects. So we work on all kinds of different projects, because anything that we work on, it will be initiated by our member group, and it will be initiated because it's a strategic priority for our members. So I think in terms of the most interesting one, I think maybe the most successful certainly have been the frameworks that we work on in terms of lending frameworks. So now we have those out across mortgages, business lending and mortgage arrears. And in terms of the mortgages, that's been the most mature. So we've had that in market since 2017. At the time, credit unions were just getting into mortgage lending. There was no kind of standardized approach. Some of the mortgages that had been given had gone to enforcement. They were found to be non-compliant. So our job was really, new regs had just come in, find a way to do this compliantly, try to find a way to do this in a standard, enable it through IT. So we'd have launched a kind of a full end-to-end solution 2017. Since then, we've seen a 20-fold increase across mortgage lending through that framework. So 7 million year one, 150 million last year. Last year, we hit €500 million in mortgage lending has gone through that framework. And in those 7 years, we haven't had a serious compliance issue, and we thankfully haven't had a serious arrears issue, so touch wood. But yeah, I think that's being delivered.
Brilliant, thank you very much. It's really interesting. Yeah, progress. You've been around for quite some time. So tell us what's a piece of innovation that you've implemented in the last 12, 18 months that perhaps not all of your users even knows there.
Probably, as I mentioned previously, a large portion of our investment or change in strategy from about 4 years ago is to move into APIs and have connectivity into the system. So obviously credit unions that are with us, they've seen the growth in that sector. They've seen what we've been able to plug into the system. It's a cloud-based API infrastructure, so it's obviously we've still got a basic core, but it's connected closely to the cloud, so we can expand those systems. In probably different to Martin, we have a very stable core. We don't have to focus on building that. It's very reliable, it's very configurable, so we can put all of our efforts into the new digital channels and plugging those APIs in. For people not on our platform, obviously they don't know that. Those of you that are, I think it's a rapidly changing piece of our business. And to what Paul mentioned earlier on, this is really our fast lane. This is the thing that's helping us grow our business very substantially and very quickly. Obviously, also mentioned, I think it was possibly on David's slides, I'm not sure, but is the where groups of people get together, so where credit unions coalesce around an idea. There's a distinct advantage because we're connecting to something once, but we're then able to proliferate it multiple times. That's speed to market, but it's also significantly lower cost for credit unions.
And what's the take-up like for people?
So from a take-up, I said to you from API point of view, nearly 40% of our business is now running through APIs. Obviously, the digital aspect of our business is 100%, so that we see that. There's very little that certainly since I've been there, that we're outputting that people are not picking up. Sometimes it takes time. It takes a bit of time, education for people to realize what the system can do. But over time, and if I look at the bigger credit unions, I see Heritage here in front of me. I don't think it's a part of our system that Heritage doesn't use. It's again, the different types of credit unions. You've got industrials, you've got community credit unions, you've got big, you've got small. So not everybody uses everything because it's not appropriate to them. But where appropriate, most people use most parts of the system.
So let's compare that to the new entrant. I like that you're on branding. That's great. What's the most advanced thing that you've got live in the credit union right now?
Live, the only credit union customer that's live at the moment is Leeds Credit Union, but that's just with loan origination. They've been operational for loan operation for the last 12 months. So that's integration with lending metrics, with the OT, and a number of other parts. But our core business is really core banking. So there we are working with particularly two launching customers, CitySafe and South Manchester Credit Union. We started 15 months ago. I think 15 months ago I had nice thick black hair. And I can't believe that Sheena and Sean still look so fresh and young. But no, it's been a long, hard journey, I think, so far. But we are really getting to the end. So we've been really co-designing, I think, this core banking platform where we've extended into savings and into integration with Nasdaq, with Nivo, with CEO apps and others. And we're in the last stages of system acceptance testing. And I think that's also from our side, and I think we'll talk about it maybe a bit later as well, but we need, people like us need innovators like I think Sean and Sheen and their boards as well. I see Mike is here as well. So it's both the boards and it is the executive teams that we needed a few people like that said, yes, we are ready to be first and to take this leap of faith with us. And we are getting to the end, so we are in the last stages of system acceptance testing. Those will be the first few real core system users, and that's then fully again on our CRM-based Salesforce platform. So I think that with a lot of integrations there as well. So I think that's going to hopefully be adding a really nice new innovative platform to the sector that can really help them grow and help credit unions grow.
Cahal, you get to do the stand back test. So when innovation stalls, is it the tech? Is it the environment? Is it us as credit unions?
Okay, well, it's never credit unions. But I think if you do take a step back, if you look at maybe innovation in any industry, I think generally it's very rarely the tech that goes wrong. It tends to be the environment that we drop the tech into. So we tend to be very, very good at building tools, but not great at deciding what procedures need to be implemented at a human level to implement those tools. How do we train people to best use those tools? So I think, look, when you see innovation stalling, it tends to be things like competing priorities. Like that happens all the time. We're trying to operate businesses that are growing at kind of a rate of knots. We have systems technology that is kind of expanding at a rate of knots, and then something on BAU happens. You know, we end up firefighting, and the innovation can fall by the wayside. I think just one maybe area that we see a lot within credit unions, kind of specifically, might be things like fragmentation. That can delay innovation. So we tend to have splinter groups. That's an environmental factor. But we also tend to have a lot of hesitation around whether or not we should go live with a new innovation. And I think sometimes we beat ourselves up around that, but it actually comes from a very, very good place. So back home, I would sit on a user group within the central bank for financial innovation, and there'd be a lot of people from the fintech industry would sit on that user group. And to listen to people in that room talk about innovation, it's very, very different to when I sit in a room with credit union people talking about innovation. And the reason for it, I think, is in a credit union, we tend to be very, very aware that what we have is a huge brand loyalty. I think David would have mentioned earlier, like in Ireland, number one for sustainability, number one for trust, number one for reputation. You know, we're very, very aware that is something that has been handed to us, that we're custodians of that, and that we need to pass that along to the next generation. So when we consider whether or not we want to take a risk on a new innovation, we have to price that in. Incumbent or new entrants don't have that, so they've got nothing to lose. Like for them, it's innovate or bust. And when you listen to fintechs talking about innovation, they're very much coming from that space. So I think maybe sometimes innovation stalls. It tends to be the environmental factors rather than the tech. But we shouldn't always beat ourselves up for it. I think we need to innovate as incumbents rather than try to compare ourselves to fintechs and innovate from like them.
So you talked about fragmentation there, which leads me to ask, how much of your time is taken up with one-off customizations or maintaining legacy systems versus actually being able to spend your time looking at the new sexy stuff?
It's a really good question. We only have one version of our software. So those of you in the room that are on our software, you know you're on 6743. So we don't maintain old versions of the software. Probably historically there were customizations in the system, but customizations have been by and large taken out of the system. The system's very configurable, and obviously because we've been here for quite a long time, anything any credit union needs is somewhere in the system and can be configured. So that is not really a problem for us. In terms of keeping that up to date, we have, when I look at the resources, because I manage them, we have between 20 and 30% of the resources that are constantly upgrading code, refactoring code, getting us onto the latest platform. So everything is pretty modern and up to date. The reason I say between 20 and 30%, I don't know where Ian is, but I was talking to him last night. The one that can read, not that Ian, the other Ian, the regulator, where is he?
Oh, he's over here.
Yeah. They're the ones that can throw a spanner in the works because...
It's not true,
they're the ones that make it change from between 20 and 30% when we get a heads up 3 weeks before something needs to be delivered. So we'd like a better heads up, and then we can deliver better on that. The rest of our time is spent on innovation, on new stuff, new digital channels, as I mentioned, APIs, our integrations into things like Launchpad, I think is something that you're familiar with in the UK from VI FinTech. That's something that we've integrated into. And these are all through open APIs that are in the cloud. I think some of the Irish credit unions would be familiar with our integrations to things like Metamo, UK Nest Egg. They're just a couple, but there's a plethora of AML engines, various different CRM engines that we're integrating to. That's really where we see the growth area at the moment.
So without the 20 years of legacy, obviously you do need access and you do need partners, and you said you need people to innovate. What's the biggest thing that holds you back?
I think initially it was funding. So you need money to enter a market like this, particularly if you focus on the very difficult, complex part, like the core system. So I think from our side, we were lucky enough to get an investment from Fair for All Finance. So we together set up a joint venture called Singlified GB. We put in our own money. Fair for All Finance put in our own money, their money. 50-50 split roughly. I think that was like a core thing that we needed. You need money, and I think it's difficult for us to, because we put in more than £1 million together, we would not have been able to ask that from credit unions to put that upfront to get live. So I think money is a key thing. And then secondly, indeed, we need a group of early adopters, people that feel, yes, we see this vision, we want to be part of it, and we put ourselves forward. So I think those are the two key things. And I think without money, really, you can't do something big like what we're doing. You need that initial investment.
So do you find you're getting asked to pilot a lot of stuff for free?
I think right now it's not that relevant because we have that investment. So we did not have to ask for a lot of money from this initial group of credit unions. I think in the future, when we switch towards, the funding that we will get from credit unions, the revenue that we generate, that has to pay for the innovation. So we have been putting much more than 100% in innovation at the moment. We need to bring that back to about 50%. In terms of product innovation, that is just something that we have to collectively agree how is that best spent. Because we are also a social enterprise. We are not depending upon grant funding. We need to keep ourselves sustainable and innovative based upon the revenue that we generate, and that's just the raw fact, basically, that somebody has to pay for this innovation.
Mm-hmm. And I guess from Progress's side, you get asked to produce a lot of new innovation just as part of the general core fees.
No, well, I would say there are adaptations to the core product which we don't charge for. It's not something that I think it's expected of us. In terms of innovating, bringing out new digital products, APIing into other things, it really depends, and this is a sort of a depends question. It depends how big it is, right? So where we have a project that's running into the hundreds of thousands or potentially millions, we will look to credit unions to contribute, and they typically do, because that's where we get a big commitment from a large group of people trying to get us all in one direction. Where projects are sort of smaller and, as Martin mentioned, maybe a little bit less likely, you're not quite sure, we will typically put the investment in, but we will try and get a core group of credit unions around an idea. I know that we've got some representatives from the Welsh Credit Union. I think Anthony's here from Cambrian. We work together with them on a product called Borrow and Join, which actually they've taken up. 6 other credit unions have taken up, and now we've got another 30 credit unions that are taking that particular product up. So, but it's not one where we would have asked for funding. We saw, what was a concrete idea. We put the investment behind it, piloted together with the Welsh credit unions, and are now in a strong position to roll it out across the rest of the market. But obviously, we're in a different position to Martin, much more mature. We've got sort of more of our own money to be able to fund things.
Yeah, I'm just interested looking at ourselves rather than just looking at, do we get everything provided for us? Well, sometimes it just doesn't work like that, because these things cost a lot of money, don't they? And let's talk a little bit about strategy. So let's talk, ask you this question, Hal. Business strategy and IT strategy. How good are we at aligning those together as credit unions?
Okay, well, I think historically there hasn't been maybe a great alignment between maybe the business strategy itself and the IT strategy. I mean, speaking to Irish credit unions, sometimes you'd almost hear it described as, maybe from time to time, it can be seen as the tail wagging the dog. So it's seen as maybe IT capability, and what the IT is capable of kind of informs us what our next strategic plan should look like. So I think that tends to be maybe a point of friction. I don't think the friction there maybe necessarily is a bad thing. Like, you'll always have friction when you're trying to grow. It means you're not resting on your laurels. It means that you kind of understand, as a credit union, you need to continue to evolve to meet the needs of your members, and you're committed to doing that. So the friction in and of itself is not a bad sign. But in my experience, maybe what has exacerbated it is we haven't had a great investment into product development skills or project type skills. So there tends to be a gap between the credit union and the vendors, and a lot of the kind of the unglamorous tasks around product development and project management tend to have no clear owner. So when we're looking at things like requirements, documentation, technical specifications, when you're working on regulatory projects, requirement traceability matrices, all really, really, really boring stuff, but incredibly important for taking a regulatory project and enabling it through IT. So I think, in my experience, that's where most of the gaps have been established.
Common pitfalls?
I think the common pitfalls is lack of clear ownership. So oftentimes, maybe in the past, when we've been trying to work with providers around integrations, there can be uncertainty over, is it the vendor that owns the integration? Is it maybe the user group that owns the integration? So I think kind of actual ownership tends to be a big pitfall. And then maybe misunderstanding maybe the investment that's needed in the overall project. So there will be the tech investment that will give you the tool, but then training people, how do we use the tool, establishing the procedures, putting the project in place around implementing the tool, that needs a kind of a separate funding model.
So a bit of a question for the room, really, and a look at us. What do we need to stop doing if we want to move faster as credit unions? Jan, you want to go first?
I would say I've heard this morning a few times, I don't want to repeat, but work probably more closely together around certain projects. We've seen that to be very successful when it's happened. I spoke to Ian from TransSave earlier today about this. It does require somebody take a leadership role within that group. It's no good bringing the group together that are just all going to sit around the table and talk. It tends to require someone who takes the drive. I saw that with Anne from Cambridge. She's not here today, but she took that drive with the Borrow and Join project. We've had projects from in the Republic with Metamo again, where we've seen particular leaders within that group get behind that group and drive it forwards. We look at the reason I mentioned Ian. We've done the integration to Launchpad again. That's largely again driven by somebody in the leadership position like Ian. That's enabled us to do that. So there are various other credit unions that are going to be able to take advantage of that. So it is a group of people, but it does also require leadership.
Yeah, Martin.
I fully agree with Jan. I think what's going to be absolutely critical is for these user groups, for credit unions to talk to each other and to agree on certain direction of travel. I think there's three main areas. One is integrations. It's much easier for us to integrate with 15 third parties than with 40. So it's really good if at least 2, 3, 4 credit unions, signified credit unions, would want an integration, and they don't want 4 different integrations. There's a lot of excitement out there in third-party integrations, but it is work every time an integration has to be made. So I think getting more common decisions on key integration partners is really important. And then secondly, agentic AI. So AI itself. We just have our new CTO Josh joining us. It's going to be a key focus for him. AI is going to be, like any industry, very transformative also for credit unions. And what are the use cases that credit unions want to explore? That in member services, it is in origination, and how are we going to pilot it? And I think that's really something that the sector needs to decide almost for us. Like we build on the Salesforce platform, like amazing AI capabilities. So it's all there to be piloted. But we need the sector basically to tell us what are good pilots to do. And I think the third area is data. So particularly around AI, you can only build good AI and train good AI models, ethical AI good models, if you have good data. So consistent good data that is available in our platform, but also would be better if it is shared across credit unions. Again, that all needs just credit unions and user groups to be together. So I think that's, fully support, Jan, your comment that I think people need to, particularly when there are so many credit unions in the room, working together and being that voice towards us is critical.
What do you think?
Yeah, let's just. I appreciate we're probably coming up on time, so I'd just be very, very brief on this. But let's give ourselves maybe the best opportunity to leverage the tech that Martin and Jan will be able to build for us by putting the correct environment in place to fully realise it. So I think that's just around operational efficiency, just making sure that we've got roles really well defined, responsibilities really well defined, and that we've got better accountability around these projects and their implementation. So.
Thank you. Quick question from the room. I think I've got 2.5 minutes on the very large countdown clock that's here.
It's haunting, isn't it?
It is quite haunting. Has anybody got a question for the panel before? Because we've got a break after this, so you will actually be able to chat to the panel if you've got any specific questions about your own tech needs. No? I think it was really interesting to chat to you guys from my perspective, and probably really interesting just to sum up some of the things that we do hear time and time again, but perhaps at credit unions we need to take a hard look at ourselves and think about how we can work together more and be more collaborative and build ourselves into the right teams that we can actually, get moving faster on the innovation and not put so many blockers in the place. And I think obviously the piece about pilots and paying for proper pilots was quite interesting from our perspective as well. We can't just always expect that you guys come up with the innovation and deliver it to us. We need to really be part of that journey with the providers that we've got. So thank you very much.
Thank you very much.